So, good afternoon, all respected participants of today's very important program, being a webinar hosted by Committee on Management Accounting, NPA and Risk Management. So, friends, the banking industry has played a huge role in the development of the economic industry and arena of the country. Friends, we all know that banking industry is the driver of the economic power and, of course, the growth of the company. It plays a vital role and important role in identifying the idle resources for their efficient utilization to attain maximum productivity. However, this process involves risk, and since the risk is directly proportionate to returns, the more risk a bank take, the higher of the generation of profit is there. So, friends, NPA is very important part to be discussed because non-performing assets are basically those assets which are not giving any yield to the bank in respect to their earnings. NPA has been categorized in several parts: substandard, doubtful, and loss. And there are various instruments of credit risk which is to be discussed today in this program. Friends, one of the very wonderful speaker, Mr. Pradeep Godbole is with us. He will be deliberating on the very important topic as discussed with you. I will like to have a brief introduction of Pradeep ji. Pradeep ji is a chartered accountant with 30 plus years of banking and financial services and business and technology consulting, auditing, accounting, management experience. Senior management position at reputed organizations, big four consulting firms like E&Y, and IT organizations like Oracle, Wipro, and other banks like Deutsche Bank, etc. He is independent director of South Indian Bank, chairman of IT Strategic Committee, and member of board committees. He is director of Risk and Compliance Professionals Association, a Section 8 company, not-for-profit company, focused on skills and capability building initiatives for BFSI industry. He is consultant and advisor to financial institutions and technology companies in India. With a blend of experience in financial services and technology industry, Pradeep ji has demonstrated thought leadership through insights and CXO suits, interactions, and executed large businesses and technology projects at top-tier banking and financial sector organizations across the world. As part of this work, Pradeep ji has trained and mentored large teams and won multiple awards for greenfield projects. So, with these words, I introduce our very learned speaker who will be deliberating on very important topic in NPA and risk management. And friends, this is indeed time when we have to learn the risk management, which is really of utmost importance, not only for the industry, but for ourselves development also. So by these words, I once again welcome you all along with the very learned speaker, Sri Pradeep Godbole ji, and I request the learned speaker to kindly start the deliberation. Thank you and welcome one and all again.
Thank you. Can I go ahead, Gyanji?
Yeah, sure. Please continue.
Okay, let me share my screen. In the meantime, good afternoon, everyone, and thank you, committee, for giving me this opportunity to talk about NPA and risk management. As Gyanji said, this is one of the important problems faced by the banking and financial services industry. As you know, non-performing assets will impact the health, safety, and the reputation of individual banks. If the bank is having high NPAs, depositors would not like to place the money with such banks, or lenders will not like to lend the money to such banks, right? So it will impact the business of the banks. And in turn, it will affect their profitability, it will affect their capital adequacy, it will affect their net worth, and it will also affect their share prices and market capitalization, because most of the banks are now listed on the stock exchange and they are very, very sensitive to such information which is coming out from the banks. Why will we look at the banks at the individual level? At the country level, at an aggregate level also, this is one of the important indicators, and it denotes the safety and the soundness of the financial institutions. As we embark on becoming a 5 trillion economy, this is one aspect where we will have to do a good amount of work which is required in this area. As you know, this is a topic is very vast and very difficult to cover it in 2 hours. So what I plan to do today is not get into the nitty-gritty level discussions, but have a broad level overview, a bird's eye view, I would call it, of the topic, and what are the critical things which are required to be done in this particular arena, and what the financial institutions are doing, what are the mechanisms which they are adopting, what are the RBI norms regarding provisioning. We will try to cover it at a very high level at this point of time. Please feel free to raise questions. Unfortunately, I've put myself in the presentation mode, so I will not be able to see your questions. So bear with me. Maybe Gyanji or someone can let me know if there is some pressing question. Otherwise, we will take the questions at the end of the session. Right. So let's look at the just a minute. I'll just share it again. Are you able to see? Just a minute. Let me just. Are you able to see now?
Yes, sir. It is visible now.
Okay. So let us look at a very, very high level. I'm not getting into complexities at this stage. Let's look at how the financial institutions work, right? So banking, as the textbook definition goes, it is lending, taking deposits for the purpose of lending. And if you look at any bank's balance sheet, almost 70% of the assets are in form of the advances which are there. And when the bank lends to any borrower, it is looking at 2 things which are very important from the lending perspective. One is its ability to pay. So the bank will try to assess the borrower's ability to pay, and this will be typically assessed based on the cash flows which are there, the type of business which the organization is running, what is the management which is there, what are the financials currently which are there, what are the projected financials. All those things will be looked at in terms of the borrower's ability to pay. One other aspect also is looked at while assessing this ability to pay is the security and the collateral which is available. Right. So if in case the borrower runs into a problem, this will come handy in terms of recovering the money which is due. So the more focus should be on the cash flows and not on the security. But in some cases, that is the way the products work. Right. So that is one aspect of lending. The second aspect of lending is the willingness to pay. And this will be typically assessed based on the borrower's past track record. Has he been honorable in meeting its commitment? What is his reputation? And all that kind of stuff. Right. So let's take a simple example. There is a bank which has got 100 depositors, each paying 1 crore of deposit at 6%. And assume that the bank is lending to 100 borrowers 1 crore each at 9%, right? We are not getting into capital and other borrowings and all that. Let's keep the life very simple, right? So what will happen if this is the case? After 1 year, what will happen is that the bank will be able to get 100 crores back from all the borrowers, 9%. So 9 crore will be your income. this 100 crores will be returned to the deposit holders, and you will have to pay 6 crores as interest. 3 crores will be your profit, right? Assume that now the situation changes. There is one borrower who does not pay, and it's a complete loss. Typically, what happens is that an account becomes an NPA. You will get some time to provide for it. But for the sake of simplicity, let's assume that the borrower does not have anything to really repay, right? So one borrower does not pay. So you will not get that 1 crore from the borrower. So 99 crores only will come back to you. And 9 lakh of interest on that loan also will not be there on 1 crore. So you will get only 8.91 crores. Now on the deposit sides, you will have to return 100 crores. So you will pay 6 crores of deposit and 1 crore loss, which is there. The loan which is not going to come back, you will have to provide for that also. So your profit now becomes 1.91 instead of 3 crores. Now take a further case, like 5 borrowers don't pay on time, right? So the amount of income now will be 5 borrowers not paying interest. So 9% on 5 crores, 45 lakhs you will not receive. So your income will be 8.55 crores now. Depositors, 6 crore has to be paid. And now you will have to provide for 5 crore of loss which is there, the credit loss, right? So now it will turn into a loss of 2.45 crores which is there. Now if this situation continues, you will have to set off this 2.45 crore loss against your past earnings. If that past earning is also not sufficient, then you will have to reduce it from your net worth. And you possibly know a case which happened in recent times, where one of the public sector banks noticed a very large fraud. The NPA was caused by a fraud situation, and the bank had to provide for it. And the loss was so high that it completely wiped out the entire capital which was there, right? So RBI had to step in and give them some concessions. You must have read that particular story. So the bottom line in this particular case is that when you lend the money, and if it is as Gyanji rightly said, a non-performing asset is the asset which ceases to generate the income for the bank, right? And there are typical conditions which are there. Simple condition is that interest or the principal is not paid when it is due. There are other conditions also which we will discuss in subsequent slides. But terms and conditions are not met, or the covenants are not adhered, or in some cases the borrower diverts the funds for some other purposes and it results in a loss, right? So if this loss happens, there are 3 impacts which will be there. First is that you cannot recognize the interest or income on that particular NPA. That's first sort of negative for you. Second is that whatever you have not received in past, the interest or income which is there, you will have to reverse it. That will be the second negative for you. And the third negative will be that you will have to make a provisions for that anticipated credit loss which is there. So this will hit your P&L. So the impact is threefold. All of you are chartered accountants, so you know that you don't recognize the income, your income will be lower. You reverse the interest, your income will be again lower. And you make a provision, your income will be again lower, right? So it hits your profitability substantially if you have large number of NPAs which are there. As I explained to you, it will reduce your accumulated profits, and if the accumulated profits are not sufficient, then your net worth will be reduced. So your capital adequacy will be impacted. The third impact which might be there, and which is not easy to understand, is that assume that there is a loan of 1,000 crores which is expected to be received, and this loan becomes an NPA. So this loan you will not have, but you will have to run your operations. You will have to return the deposits to your deposit holders. So you will have to borrow this 1,000 crores from the money market, or make some borrow from other lenders and make good that shortfall which is there, right? So that will impact your liquidity. And what it means is that you will have to pay additional interest on top of it, which will also hit you in terms of reduced profits which are there. So to summarize, NPAs will impact you in three ways. It will impact your profitability, it will impact your capital adequacy, and it will impact your liquidity. And the impact of all these things will be on the reputation of the bank, the safe health and safety of the bank which is there, because borrowers will typically look at how safe the bank is if they are going to place the deposits with the bank. So that's at a very, very conceptual level what this thing is. Now let's get into some specifics. So when do you consider an account to become an NPA? So for example, take this case of due date. This is the date on which the money is expected to come, the interest and or principal is expected to come, right? So if the money does not come within 30 days after the due date, it is called SMA 0, special mention account. These accounts are classified as special mention accounts, SMA 0. This is your first warning signal that this money could become an NPA, right? So you should start taking efforts to recover the money, right? If this money is still not received after 31 days up to 60 days, it will go into SMA 1 category, special mention 1 category. If still the money is not received after 61 days up to 90 days, it will be classified as SMA 2, right? And if the money on the 91st day, this account will get classified as a NPA. And one point which you have to understand is that this NPA definition is not per facility, but it is per borrower. So for example, if there is 100 crore which the borrower has borrowed, out of which 10 crore is a term loan, out of which 5 crore is expected to repay, and he does not repay for 90 days. So on the 91st day, not just 5 crores, but the entire 100 crores will become an NPA, and then the provisioning norms will kick in. IRAC norms, income recognition and asset classification norms, they will kick in and the provisioning will start, right? So you have to be very sure as to what is the total exposure, how much is it overdue and how much is to be recovered, and if it is not recovered, what will be the impact on your financial statements, right? Going forward, this NPA is further classified as substandard. So this account becomes NPA on 91st day, and for 12 months, it will be considered as substandard. If the money is still not received after 1 year, after becoming an NPA, then the classification goes into doubtful 1. So the classification is DA1, DA2, and DA3. So DA1 is up to 24 months. DA2 is between 28 to 48 months, and DA3 is greater than 48 months. And there are provisioning norms which are there relating to substandard and DA1, DA2, and DA3 levels which are there. And at DA3 level, anyway, 100% provision has to be made, right? So at DA3 level, the entire asset has to be provided if not received. The loss asset is a slightly different concept, where it may happen that the bank assesses or the auditors or the RBI auditors assess that this money is not going to come up. So you don't have to wait till 48 months to provide for that entire amount. There is a substantial security dilution which is there, or in some cases a fraud is noticed, right? So in that case, what happens is that 100% provision should be made for such assets immediately as the asset is classified as loss asset. In case of fraud, the RBI rules permit the provision to be made over 4 quarters. So over 1 year, you will have to provide for it, not beyond. You can't wait till 48 months if the asset is considered as a loss asset, is identified as a loss asset by the bank itself or by the regulators or the internal or the external auditors who are auditing the account, right? So as I said, once the account becomes NPA, the IRAC norms will kick in and you will start making the provision, right? And we saw the impact of that provision where it will hit the bank, right? So what typically should happen is that if you are to manage this risk of NPA, right, the best option or the best defense against this particular risk is that you should avoid this particular situation. You are not avoiding the credit, but you are avoiding the riskiness of that credit through strong underwriting and credit monitoring process. So you should have a very strong credit underwriting process so that only good customers are onboarded. And secondly, even if you give a loan to say 100 borrowers, some people are likely to face the challenges and they are likely to get into an NPA stage. But that number should be small number, and that you should be able to identify that those such borrowers early in the life cycle so that you can take corrective action. And that will be helped by the credit monitoring process which is there. We will talk about the typical mechanisms which are adopted by the banks to make sure this particular thing. The second thing which is more important is that assume that the account has gone into SMA. You should make all-out efforts to pull it back to the standard category, right? From SMA 1 and SMA 2, 0, 1, and 2, if you find that accounts, you should make a concerted effort to bring it or pull it back into the standard category. You will have to engage with the borrower and see what can be done so that he is able to meet the obligations. We will see the recovery mechanisms which are available over here, right? Then the third is that the case is that if it becomes an NPA, then you should have a prompt recovery action which should be taken, right? So that is what is the typical process or the thought process philosophy should be there with the banks, right? In terms of the organization, typically up to 90 days overdue is handled as part of collection, and in many banks the assets are transferred to a separate group, stressed asset group, once it becomes an NPA. But it depends on bank to bank, but that is what the thought process is. In collection management, you try to pull it back into the standard category, and then if it becomes an NPA, then the rest of the recovery mechanism should kick in on a prompt basis. That is what is the way to address this particular risk. So there are three important items which are there, which are typically looked at by the financial analysts and the regulators, the investors. First one is called the gross NPA. So this is nothing but the amount of NPA divided by your total advances. If suppose you have lent 100 rupees and 10 rupees is not in NPA, 10 divided by 100 is your NPA, that is 10%, right? Net NPA is what you will do is that once it becomes an NPA, you will have to start providing for it, right? So net NPA is nothing but whatever is the NPA after providing for that, making provision for that particular loss, right? So, for example, 5 rupees are provided against this 10 rupees of NPA, right? So, net NPA is 5 rupees divided by net advances. That is 100 rupees minus 5 rupees which you provided. So, 95 rupees. So, 5 by 95 is your net NPA percentage which is there. Typically, the gross NPA of good banks is under 3%. Gross NPA is under 3%. And net NPA is typically under 1%. That is, the top tier banks are or well-managed banks are having that kind of ratios which are there. The third ratio, which is very, very important from the analysis perspective, is the provision coverage ratio. That tells you how much of the gross NPA has been provided for. You have debited your P&L and made a provision for such losses, right? So in our case, 5 rupees are provided out of 10. So your provision coverage ratio is 50%, right? So typically the expect industry level norm is about 70%, and the Reserve Bank also is pushing all the banks to reach that particular stage. Some of the banks were not at that 70% stage. So the Reserve Bank has been asking them to make additional provisions and reach to that 70% provision level. Provision coverage ratio gives you a sort of safety margin as to whatever are the NPAs, how much of it is provided for. So you know that there is no further surprises which are expected to arise out of this, right? So that is what is these are the three important terms which are being used, and this is what is the industry standard which is there. Before we proceed into the actual nitty-gritties as to how the whole thing works out, let's look at some of the big picture ratios which are there. So at India, at the overall banking, say, scheduled commercial banks level, the ratio is right now at 5.9%. It used to be at around 8% in September 20, but good amount of work has been done by banks, and that is at 5.9% today on 31st March 2022. In terms of net NPA, what we talked about is right now at 1.7% in March 2022. This used to be around 2%, and that also, because the provision has been made, the amount is now at 1.7%. So again, there is some improvement in terms of net NPA ratio which is there, right? The provision coverage ratio is around 70% right now, which is a decent percentage which is there. In terms of absolute figures, the gross NPA is 6,63,000 crores, 6.63 lakh crores, and against that, the total advance given by the bank, scheduled commercial banks, is 126 lakh crores, right? Net NPA is 1.68 lakh crores, right? So if you look at it, you will feel that yes, we are making progress. So yes, we are making progress, but these figures are not comparable with our peers. So if you look at the BRICS, Brazil has got a gross NPA of 2.2%, vis-a-vis our 5.9. China has got 1.7. South Africa has got 4.5. Only Russia has got a higher figure than us. It is at 8.9%, right? Amongst the developed world, if you look at it, US has got 0.8%, UK has got 1%. So we have a long way to go. If we are able to tackle this issue of NPAs, then that 5 trillion is a certain reality, I would say. But this is one of the drawbacks which is there. One other interesting observation, that out of this 6.63 lakh crores which are there, there is a report which came very, very recently, not less than 30 days, I would say, that top 50 defaulters in this list, they contribute almost 90,000 crores of NPAs. And some of the famous names, infamous names, if I may say so, all those names which are there, running into thousands of crores. They have defrauded the banks and they have run away from the country. Such cases. So all such people, they contribute almost 90,000 crores out of that 6.63 lakh crores which are there. Right. So any question before we dig deeper into the actual conversation around how to tackle this problem? I guess there is no question, so I'll proceed. So let's look at why why we have such a large NPA levels in the industry. So the first and the foremost reason is the weak credit underwriting. So the credit underwriting, as you know, was not up to the mark with many banks in past. The financial analysis and cash flow analysis was not rigorous. Many of the banks were not using the rating models or credit scores, which we very frequently hear and use nowadays. So that was also not used. In many cases, what the lenders made a mistake is to look at the asset rather than look at the cash flow. So they lent the money thinking that they have got sufficient cover in terms of security and collateral. And now when they try to liquidate this security or collateral, they are not able to recover, this was not a very good strategy, I would say. Also, in some cases, you may find that there was a name lending type of case where the people would say so and so would never default. He has got a good reputation, he would never default. But we have seen cases in recent times where even the AAA rated borrowers have defaulted, right? So that all those things are putting pressure on the financial institutions. RBI on its part is putting tighter controls in credit underwriting. They are insisting on usage of credit rating and scoring. They are insisting on automation, which is there. And RBI has also created a lot of databases where the information is now available, which can help in good credit underwriting. We will talk about a few of them as we go along, but this is one of the major reasons. The second reason is the ambitious cash flow projections which are there. Many times the business projections were unrealistic. Not only this was in case of working capital loans to get money to finance your day-to-day running, but even in case of project finance or infrastructure finance, whatever cash flows which were anticipated, they were very aggressively estimated. And as a result, when the projects went into a problem, the cost overrun happened, the projects ran into trouble, there are NPAs which have come out of it. One of the other reasons also has happened is that some of the promoters have gone into unrelated areas where they did not have the expertise in past. So they went into telecom, some of them went into power, some of them went into infrastructure, roads, sports, all those kind of things. And that also, and they again overestimated the cash flow generation from such businesses. And that has resulted in the loss which is there. The third reason is the credit expansion. So this is a psychological case where if the economy is doing well, you assume that the borrowers will do well, they will repay on time. And so your credit underwriting standards get diluted. Caution is thrown to winds, as I would say. So that also affects, and this happened especially in the period between 2008 to 2012. There are senior RBI functionaries who have pointed that out, that the credit underwriting during that period was not very rigorous, which was there. The fourth case is because of the weak documentation and credit monitoring. So in many cases, what was noticed is that the bank had given a loan against a security, but that security was not perfected. The documentation was not taken properly. The registered or the charges were not registered on a timely basis. So the banks did not have the recourse to such security or the collateral which was there. The credit monitoring was also very weak. So the early detection was not happening. Now RBI has come out with something called is the early warning signal system, and all the banks are expected to follow it, especially for the assets over 5 crores, facilities over 5 crores. These norms have to be followed. So that is trying to tighten up the process now. But in past, that was one of the reasons which was there. The next reason was the weak recovery system, I would say, where the philosophy of recovering or pulling back from SMA into standard and trying to aggressively go after the borrowers to recover the money, that kind of a thing was not happening. And as a result, you will find the cases which are lingering back to ages. The legal case system is also not helping because some of the cases are lying with the courts for more than 20 years now. Right. So this is a systemic issue as well as internal to the banks which are there. The next reason why the NPAs have happened is a diversion of funds or fraudulent management. Right. So in many cases, what happened is that the borrowers borrowed the money from the banks, and this money was invested in the associate companies or in the stock market or in the unrelated areas which are there to the business. in some cases, this money was advanced to their own groups or group companies or associates, or in some cases, the actual funds transfer happened through a fictitious trade transaction to show off a payment of a trade transaction. The funds were transferred, and then once the funds got transferred to these group companies, there was no trail left with the banks to track it down where the money went and what happened to that money. Right. So diversion of funds was done, and fraudulent management was behind all these activities. Many such cases have been noticed. Whenever we do a forensic audit after an account becomes an NPA, we find that this is the major reason which is there, that the fund diversion has happened. And there are many cases which, even if you do Google, you will find that this information is available in public domain, that an account became an NPA, and the primary reason for that was a fund diversion which is there. Unfortunately, both credit underwriting and monitoring was not able to identify such cases. Right. So that was which was there. The next case is a non-cooperative borrower or a willful defaulter. Now, fraudulent type borrowers anyway. So a non-cooperative borrower, as the term defines, is that the borrower is deliberately trying to stall the efforts of the bank to recover its money which is there, right? So they will not provide the necessary information, or they will not provide the access to the assets which are financed, or they will obstruct the sale of securities which is there. So they will stonewall the efforts made by the bank to recover the NPAs. So these are, there is a norm which is prescribed by RBI, under which a borrower can be classified as a non-cooperative borrower. You can't classify any borrower as non-cooperative just at your whims and fancies. There is a process to be followed, a notice to be given to the borrower, opportunity has to be given to the borrower to explain his side of the situation, and only at a senior level that decision can be taken. Right. The second type of fraudulent borrower is a willful defaulter, and willful defaulter is defined in multiple ways. One is that he has diverted the funds. He has not utilized the funds for the purpose for which it has been lent. In some cases, the borrower has the ability to pay. He has got cash flows, he has got assets, but he just doesn't want to repay the loan which is there, right? In some cases, the borrower has also sold off some of the assets or removed the assets which was provided to the bank as a security without informing the banks. So such type of borrowers can be classified as willful defaulters. And they again are there is a process to define anybody as a willful defaulter. But when you are analyzing the causes, these type of fraudulent borrowers are also contributing to that 6.63 lakh of NPAs which we are carrying right now, right? And final reason, and which is a genuine business reason in this case, is the business cycle or the external events which are there. So just to give you some example, right? There could be a change in the government policy which will say ban imports, or it could ban exports which are there, right? In that case, it will impact the business of the organization which is there. It could also be a competition action which is there. You know a case very recently that a telecom player came into the market. He offered value-added services at a very cheap rate, grabbed the market share, and that affected the entire telecom industry per se. Right? So that kind of a situation will result in some amount of NPAs which are there. There could be other case like you know that the Chinese goods are flooding our markets, right? So that has impacted our Indian manufacturers which are there, right? Another example is that India used to export cashews to many countries in past, but Vietnam has taken very aggressive steps to promote their own product, and that has impacted our cashew industry which is there. Another external event could be use of technology which is there. So you know that we are nowadays buying things on the online portals which are there. and that has got an impact on the brick and mortar shops which are there. So the shops, retail shops or the malls which are there, they will get impacted if we if we buy the goods using the online sales channels which are available, right? But these are the cases, genuine business cases, where the borrower does not have much under his control, and that as a result of the business failure, the account turns into an NPA, right? So if you look at the reasons why the account becomes an NPA, right? Some of the factors are external, right? Business cycles or external events, but many of the factors are internal to the banks or their functioning, right? So if they are able to tighten up their controls relating to the lacunas which are noticed, then we will be able to tackle the NPA problem which is there. So with that, let us okay, before that, one other challenge in NPAs, which is very important to understand, is that if you look at the figure on the left-hand side, right, the amount of time, effort, and cost which is taken is exceptionally high, especially in case of retail NPAs, which are spread across the country. They are different types. Some will be educated, some will be partially educated, some will be old age, some will be housewives. All those things are there. So there is a lot of time and effort. The numbers itself are very large. In some cases, the products itself are unsecured in nature. For example, credit card or personal loans. These products itself are unsecured in nature. There's no security available with the bank, right? So the time, effort, and cost is substantially higher. And the results and the returns are not to that extent of effort and time and cost which is being spent. So the ideal state is to have the situation reverse, where you have lower time, effort, and cost. So how do you do that? By using an efficient methods of identifying the potential borrowers who could default, going after such borrowers, aggressively following on the NPAs which are there, using technology and the data available which is there. You can reduce your effort, and that can actually optimize your results and returns which are there. So that is the desired state which we have to aim to achieve if we want to become a 5 trillion economy. Now, let us get into how the NPA and risk management actually works. What are the regulatory framework? What is the legal framework which is there? What are the controls which are adopted by the banks to handle such things? And what is the technology which is used to address that particular risk? So the first and the foremost is you need to have a risk management policy, process, and the organization structure. So typically, there is a business teams which are sourcing the proposals. There is a credit team which looks at the credit underwriting aspects. There are people who are independent who approve the credit. There is a separate credit monitoring team which looks at the credit, gets the documentation, monitors whether stock and book date statements are coming on time or not. And if the account becomes an NPA, then there has to be a recovery team which should step in to get the money. If it is below 90 days, typically the collection team will have a role to play. So that kind of the structure has to be put in place. So there has to be a policy, process, and the organization structure, what I described right now, which might have to be put in place. So typically what happens in case of recovery, especially in case of retail portfolios which are there, since the numbers are very large, the banks are actually using the services of external recovery agents in many cases. And there are specialized agencies which do this type of collections. Retail typically is handled as part of an outsourced recovery agent team, and which is supervised by the bank. Whereas MSME and corporate type of NPAs, these are handled in-house. There is typically a stressed asset group which is there, which looks at such customers which are there. right? So that is the way typical organization structure is there. But when you take the help of external service providers, right, the recovery agent, there are also restrictions or the conditions which are required or some rules which have to be followed. And typically, there is a misconduct risk which comes up as a result of employing such recovery agents. Because in many cases, what happened was these recovery agents adopted questionable means. They threatened, they humiliated the customers in public functions. They adopted the high-handed approach, and the customers actually complained to Reserve Bank of India. So Reserve Bank of India has come out with a guideline for recovery agents to handle this misconduct risk. So the box on the right-hand side, this is what is emanating from the organization structure which you adopt. Typically, if it's an in-house team, the bank can control the people who are there in the team, and they can monitor what these people are doing. And as a result, there is better control. But if it's outsourced, then there has to be a control which needs to be put in place. We will talk about this in more detail as we go along, right? The other important thing which is there is the preventive and detective controls. As I said before, the best form of defense against this NPAs is to have a good credit underwriting and good credit monitoring process. And what I mean by preventive and detective controls is nothing but these two factors: credit underwriting and credit monitoring process. So there are multiple layers of such controls which are there, and I have tried to list out a few of them, which will help the bank to identify and weed out the borrowers at the early stage itself, at the assessment stage itself. And in some cases, the controls will be adopted at a later stage to identify the weaknesses early, and then based on that, corrective action can be taken on a proactive manner rather than a reactive manner after then account becomes NPA, 90 days have passed, right? So typical credit appraisal and sanction process will involve the KYC checks. As you know, nowadays the information is available from various sources which are there: PAN, Aadhaar. You can check out on the MCA website who are the directors. Are there any proceedings against those directors? You can check out the GST records, whether the person is registered under GST, what is his turnover reported under GST. There is MSME Udyam registration is also there, where MSMEs are registered now. There are negative lists from the anti-money laundering perspectives, which are published by the regulators or by the service providers who are monitoring all these things. So if any borrower is on such list, obviously there is a early warning for you to avoid such borrowers, right? So that is one. RBI has also been maintaining the database of non-cooperative or willful defaulter database, what we talked about. So all such cases, the banks have to report to the RBI, and RBI is maintaining the such database. So if any customer, any borrower or the directors are there on that willful defaulter database, it's an early warning for you to avoid such type of borrowers which are there. There is also a central fraud registry which is maintained by RBI. So whenever there is a fraud which happens, be it credit, be it non-credit, these are reported to RBI. And there is a central fraud registry which is maintained. So you can check out whether this name is appearing on that central fraud registry or not. So these are some of the checks which will tell you that we should avoid such type of borrowers. The next set of control is credit bureaus or credit rating agencies which are there. So these are nowadays very popular. You must have heard about them already. So a score of personal credit score of 730 and above is generally considered good credit. Similarly, a credit which is above BBB is considered investment. The rating which is given by the credit rating agency is considered as investment grade. The preferred grade is between AAA, AA. A is the preferred one, but BBB is the lowest of the lot, which is considered as investment grade. So if your rating of your borrower is below this grade, or if the credit score of the borrower is below this level, you have to take extra precautions. You have to see how your risk is getting mitigated, what kind of mitigations which are available for you, so that your money comes back. If the money is not able to come back, what kind of security, collateral, terms and conditions which you need to put in to protect yourself, right? So that is what which is there. When you are lending, you have to also look at the product characteristics which are there, right? So typically when you, as I mentioned, credit card or personal loans, these are unsecured in nature, right? Whereas in case of housing loans, you will take the house as a mortgage. Typically, there will be a loan to value ratio. So you will, if your loan value is 80 lakhs, your property value should be 1 crore. Typically, 80% LTV ratio is maintained, right? Or there could be a X times the loan should be the security value. That kind of a policy which can be put in place by the banks which are there. So when they are lending against shares, for example, the margin is 50%. In case of stock and book dates, so typically there is a margin of between 15 to 25% which is there. So if the receivables are 100, the bank will lend only 75 against it, right? So that kind of safety mechanisms will be brought into the picture. If it is a LC or a guarantee, typically some cash margin will be taken, 10 to 15% cash margin will be taken, and that will be under lien, which will be available with the lender which is there, right? Apart from this, there are external information sources which are there, which can be utilized in the credit underwriting. And one such important thing is called CRILC, Central Repository for Information of Large Credit, CRILC, as this is called. And this was set up initially as part of the RBI's banking and supervision department for their work, but that has now been extended, and all these scheduled commercial banks and all India financial institutions, they are reporting exposures above 50 crores to this CRILC repository. Whenever loans are given, the banks are expected to report. So whosoever has lent more than 50 crores, the details will now be available in the CRILC database. So when you are lending, you can find out how much is the money which has been borrowed by that customer from other lenders who are there, right? So in terms of CRILC, 60% of the entire bank credit and 80% of the NPAs, all the details are available in this CRILC database, which RBI has created. So you will look at CRILC while lending, but there are also other information which is available in CRILC. Like, for example, what is the total exposure? What is whether the account is in the special mention account category, which we talked about before, whether any account is considered as non-cooperative or willful defaulter, which is there, any account is considered as fraud. All those things will be you will be able to identify from the CRILC repository which is there. Other very important repository which is available for analysis is called the Cersei Repository. Cersei is nothing but Central Registry for Securitization, Asset Reconstruction and Security Interest of India. And that is what that acronym Cersei comes into picture. So Cersei database will tell you Cersei is a not-for-profit company, Section 25 company. This has been formed under the Cersei Act of 2002, what the banks are expected to do is that whenever they take any security or collateral, they are supposed to report to this Cersei. They are expected to register their charge. So you will be able to find out who are the lenders who have lent and what kind of security do they have, what is the seniority of the claim which you have got. All those things you can find out from Cersei. And Cersei will have information about immovable property. It will have information about hypothecation of plant and machinery, stock, book dates. It can also have information about the non-tangible assets like intellectual property, know-how, patents, copyrights. These type of information is also available in Cersei. So the banks can utilize this information while granting the credit itself to weed out the borrowers who can turn into potential problem going forward. In addition, there are service providers who have come in, and these are fintechs which have come into picture. And so one of the fintech actually provides an analysis of bank statement, which is there. So the borrower may have an account with, say, 10 banks. So this particular utility will be able to get the information from all 10 banks, put it, analyze it, and will tell you whether the amount has gone to any associate companies or not, right? So that kind of information can be available through these fintechs which are there. There are fintechs available which can provide you information with the negative news which is there. Of course, as part of credit underwriting, you will do the financial analysis, the ratio analysis you will do business and industry analysis, you will analyze the cash flow. In case of project reports, you will see the projections which are there in those reports which are there. One other thing which is also put in place by RBI is the Prudential exposure limit. How much money you can lend to an individual borrower or to a group of borrowers, or if you are lending to, say, sensitive sectors like commercial real estate or capital markets, how much as a bank you can lend to such sectors. There are limits which are put in. So the Reserve Bank of India is also trying to curtail the risks which is there, right? The other thing which is there as part of the the exception approval or the authority metrics which is there. So that is what there. Typically, terms and conditions will be put in. So margins, as I talked about, the LTV, as I talked about, there will be cash margins which will be taken under lien, which will be there. There could be conditions that the promoter has to bring in certain percentage of the money before the bank will lend. That kind of a thing is also there. One other important thing which the banks typically take is the personal guarantee from the directors or the major shareholders or the promoters which are there. And there is a very recent judgment which is there where the Supreme Court has said that these personal guarantees can be invoked and the monies can be recovered by through invocation of these guarantees which are there, right? Once this sanction happens, so you are taking all precautions while sanctioning. The next stage is the documentation which is there. So you need to have the proper documentation in place. There is a laws of limitation which comes into play that every 3 years you will have to obtain the new documentation about indebtedness. Equitable mortgage is valid for 12 years. You will have to take a fresh equitable mortgage in that case. You will have to register your charge with Cersei or the ROC. ROC anyway, all of you being chartered accountants, you would know ROC charges anyway. So I'm not digging deeper into that. One other point to note is that in many states like Maharashtra and Gujarat, the equitable mortgage has to be registered also. So then only it is treated as perfected, right? So that is what will typically have to be done. The post-sanction monitoring is done through the stock and book date statements, typically in case of working capital. If it's project finance, then you will obtain the project finance status reports which are there. You will monitor the account conduct, how many checks are bounced, how many LCs or guarantees are devolved. Are there enough credits happening in the account or not? Debits and credits, are they in line with the projections which are there? This is one thing which was noticed in past, that the borrower will take a loan from one customer and they will open an account with another customer. So the receipts will be through that other bank account, whereas the loan will be taken from bank one, right? Whereas the receipts will be there in bank two. Now RBI has tried to plug in that gap, that only the banks which are lending can have the current account which is there. So now the banks will be able to have a better control on ensuring that all the receipts are getting accounted in, and how much are those receipts, how much are those payments, are they in line with the projections or not, right? So all those things can be done. Covenants monitoring will be also part of the post-sanction monitoring, which is there. So these are the cases where you will try to find out if there is anything which is weakening your position vis-a-vis the borrower which is there. One other important thing which has been implemented by the Reserve Bank of India is called the early warning signal system, right? So early warnings are nothing but the indicators which will tell you that there are credit concerns with the borrower and the credit quality is deteriorating. So RBI itself has specified about 45 such indicators. So some of the important indicators are like, say, for example, there is a drastic drop in profit, or the profit is much higher than the peers when the whole industry is facing the downturn. If a company is showing exceptionally high profits, that is a sort of early warning which is there, right? The cases where the number of checks bounced are much higher. The cases where there are high number of LCs or guarantees which are getting devolved, or there is a raid by income tax or sales tax or GST officials which is there. Now that can impact the business and that can have an impact on the repayment capability of the borrower, right? So all those indicators will tell you that the credit quality is deteriorating. Apart from this 45, there are other 80 indicators which are being identified by IBA and the Boston Consulting Group. They have also given these indicators. And what the banks have typically done is implemented a system to identify such indicators to find out what are such cases which are there and analyze those cases. And RBI has come out as part of its regulation with one more thing, which is called RFA. That is the red flagged account. So when you have multiple early warning signals which are coming in case of a borrower, those accounts can be termed as red flags accounts. And these red flag accounts are the ones which need deeper investigation and analysis. And that is also getting reported to the CRILIC database, what I talked about before. Now, early warning signal is supposed to be implemented for the exposure above 50 crores, but many of the banks have gone and implemented it at a lower threshold also. So whatever is above 50 crores, you are expected to follow this discipline and try to identify the problems early in the life cycle. The RFA accounts are also to be reported to the board. There is a committee which is called the Special Committee of the Board for Monitoring the Frauds, right? So SCBF, as it is called, that committee has to be reported about such RFA accounts which are there. Right. So that is what is already there put in place. I have already talked about the monitoring through the SMA 0, 1 and 2. So these are the preventive and detective controls which are there, which have to be implemented if you want to tackle the NPA problem. If you don't allow the bad credit to get into your books, some borrowers are likely to default. It's part of business because you are taking the risk in lending. But that percentage should be lower. That should be your aim. And you should be having a mechanism to identify such accounts early in the life cycle so that you can take corrective action around it, right? The remaining boxes we will talk about in subsequent slides. So what is the regulatory framework which is there, right? So as we talked about, there is RBI guidelines regarding the credit underwriting and monitoring, which I talked about. There is a master circular on loans and advances. There are circulars on large advances, circulars on guarantees and co-acceptances, foreign exchange transactions. So all those things are there. In terms of credit monitoring, there are guidelines for monitoring the end use of funds, exchange of information between the financial institutions which are there. I also talked about the prudential exposure norms. So those also need to be followed. Many cases, the banks have also set up the internal limits in addition to the regulatory limits which are there, right? So that could also be there. RBI collects information from the financial institutions. There are about 200 odd returns which are there, which are to be submitted by the banks to the Reserve Bank of India. Apart from the CRILIC and Cersei, what I talked about before. right? So that is also there in place. And there is another sort of mechanism which is implemented in recent times, which is called the risk-based supervision. So risk-based supervision collects the information for their off-site monitoring activities. This is typically used by the supervisors when they come for audit, but that information is already available with the Reserve Bank of India even before the people come into the bank and try to look at your operations. So a lot of information is now available with the Reserve Bank of India through these returns which are there. I also talked about non-cooperative borrower or willful defaulter. There is a process which has to be followed, and there is a database which has to be maintained. The other important thing is that whenever an account turns into an NPA, you have to examine the staff accountability. The objective here is not to penalize the staff which is there. There are possibility of a genuine business judgment error which might be there, but in many cases, the staff has been found to be colluding with the borrowers, not following the guidelines which are there. So in all such cases, the staff accountability has to be examined, and then there are sort of slabs which are there up to 10 lakh, how it is to be handled, 10 lakh to 1 crore, how it is to be handled, 1 crore to 50, 10 lakh to 1 crore, 1 crore to 50 crore, and above 50 crore, how it is to be handled. That is what has to be examined in detail whenever an account becomes an NPA. If an account becomes an NPA due to fraud, then obviously there is a reporting of frauds which has to happen to the RBI, and typically a forensic audit will be undertaken to find out the reasons for such losses which are there, right? One other important RBI regulation in terms of regulatory framework is called the Income Recognition and Asset Classification Norms which are there, IRAC as it is called, right? So this particular slide actually summarizes how when an account becomes an NPA and what kind of conditions which have to be followed. So term loans, the interest or principal remains overdue beyond 90 days. Overdraft or cash credit, this is a running account, right? So this will become an NPA when it is out of order. And what do you mean by out of order? When it is continuously drawn beyond the sanction limits which are there. There are no enough credits in the account to service the interest which is there. So during the 90 days which are there. So that will be considered as a out of order situation. In remaining cases, typically 90 days is the rule which is there. In case of agriculture, it is based on the crop seasons because the cash flows will come only when the produce is sold as it is there, right? So that is how the account will be treated as NPA. Identified as an NPA after 90 days, or in some cases, as we saw in case of overdraft or cash credit, this will be identified even before an account becomes before 90 days, which is there, right? So how does the provision work now? So the provision works based on the three categories which are there. Substandard, there is a provisioning norm which is there. Up to 12 months NPA. The account remains in NPA for 12 months. Up to 12 months, this will be called substandard, and there will be a percentage provision which will be required. Beyond 12 months, up to 48 months and beyond, this will be called doubtful assets as DA1, DA2, and DA3, what I talked about before. And again, provisioning norms are applicable. And as in case of loss assets or if there is a fraud, 100% provision is required to be made immediately. In case of fraud, that provision will be made over 4 quarters. Now, in terms of the actual provisioning itself, right, there are provisioning will happen based on 2 factors. One, the time period which is there, that is one, whether it is substandard or doubtful or loss, that is one. And second part is whether it is secured or unsecured, right? So in case of substandard assets, which is an NPA for up to 12 months, then 15% of the amount which is outstanding, you will have to provide as an NPA provision. And as I told before, the provision has to be made for the borrower and not per facility, right? As I told you, so 15% in our example, if 5 crore is not paid on time, the entire 100 crore will become substandard, and 15% of that, 15 crores will have to be provided as a provision. If it's unsecured, 10% additional, so 25% will have to be provided. Doubtful assets, again, secured and unsecured, there are different percentages are there. Secured part 25%, unsecured, you have to provide 100% if it's DA1. If it's DA2, you will provide 40% and unsecured 100% again. And beyond 48 months, you will provide again 100%. So there, like this, there is an RBI circular on IRAC norms, and based on which the provision will be made. This is as far as the NPA is concerned. Now, the banks are free to provide any additional provision which they want to provide as a prudential measure, as a sort of safety requirement. They can make an additional provision for the NPAs which are there. So instead of 15 crore, the bank may decide that they will provide 25 crores, because in the next lot, you will have to provide additional. Once it becomes DA1, you will have to provide additional. You might want to provide it upfront so that you will be able to manage your profits accordingly, right? So that is what is permissible, and that provision can be made. Apart from this, the RBI also requires the provision to be made for the standard assets. And these standard assets are the assets, and a certain percentage has been specified based on the type of advance which is there. So it is ranging from 0.5, 40% for general advances, and in other portfolios, it is ranging from 0.25% to 2% which is there. The objective of this is to make sure you are building the war chest to meet your timelines, meet your provisioning requirements. So you're providing early in the life cycle for any losses which might happen in future. That is the purpose behind having the provision for the standard assets which is there. Any question before we proceed? This is the next two slides are one of the important slides. So I would like to take a pause and see if there are any questions. Am I running too fast? You are understanding, not understanding? Gyanji, I hope the participants are available and they're okay. Good. So we will proceed. Now, this is the most important part. Can you put on mute, sir? I think somebody is on. Okay, thank you. So what do you do now when an account becomes overdue, say SMA 0, 1, 2, or it becomes an NPA? So there are multiple options which are available to the borrower, to the lender, right? So first option is the upgrade. So typically in our case, for example, only 5 crores is a problem. The rest of 95 crores is not due. You are having there is no concern regarding the remaining 95 crores. If the borrower pays this 5 crores, then the entire account will become standard, right? So upgrade is one such option. So whenever an account becomes an NPA, you will have to assess how much of the amount is actually overdue and whether the borrower has got the wherewithal to repay that amount to bring it back into the standard category or not, right? So upgrade is the first option available. Second is the cash recovery. This is again, it can happen through attaching the cash flows which are there. You can have a lien on the deposits which are there. Typically, the agreements provide for right of set off. So the credit balance can be set off against the debit balance which is there. If there is a cash margin against the bank guarantee or LCs which is there, that can also be used as a margin to set off this particular recoveries which is there, right? So cash recovery is again one other option which is permissible. Third option is the takeover by other banks or financial institutions. So This option is available only if you can identify the problem early in the life cycle. If an account becomes an NPA, obviously nobody will be able to take over that account. Nobody would like to take over your problem on their books. So this option is available only when the account is in standard state. And this is where the credit monitoring can come into picture, and also the credit assessment cycle will come into picture. If you find that the borrower there is a huge exposure as compared to the bank size or the borrower size to the which is there, the bank can request the borrower to find another lender to take over some portion of the borrowing which is there, right? So that kind of a thing you can always try to get into much before in the life cycle. At the time when you are assessing itself, you can put a condition that they should get another borrower for the additional finance which is required. Or you may say that since our exposure is more than our risk appetite which is there, then in that case they can look at some other lender who can take over that excess exposure which is there, right? So takeover is one other option which is there. The next option is the sale, security or collateral possession or the sale. And now if there is a proper security documentation is in place, the bank can take a possession of the security under the Cersei Act, and that the Cersei Act allows you to take the possession without the court sort of proceedings which are there. And this possession can be symbolic possession, or it can be a physical possession of the property. So you can put a board saying that this property belongs to so and so, that kind of symbolic possession, or you can actually take over the possession of that particular property. Once you take the possession of that property, you can typically auction that through a open auction process, and you will try to recover the money which is there, right? The next option is invoking the personal guarantee. As I talked about, the recent Supreme Court judgment has given some fillip to this type of recoveries. Previously, the banks were not going aggressively after it, but now they are going after it. So in case you have taken guarantee from the directors or the shareholders or the promoters, then based on their net worth, you can go after the assets which are owned by such people, given by the person who is giving the guarantee. You can go after such assets and you can recover your money by calling the guarantee, right? The next one is a slightly tricky one. It's called the restructuring. Now, restructuring, there is a RBI circular issued in 2019, and that is called Revised Framework for Resolution of Stressed Assets, right? And that is to address the issue of restructuring as an option. So in many cases, it may happen that the borrower has got a running facility, but he is facing some issues, right? So you may give him a temporary sort of facility which is there. Or you may decide that you will extend his tenure of the loan, or you can change the interest rate of the loan, or you can give additional financing to that particular borrower. Restructuring is nothing but giving a concession to the borrower which is there, right? So restructuring is also a form of recovery, because you are you are allowed to exercise this option when the account is in standard state. That should be the typical way to handle it through the credit monitoring process. Identify the problem early, and when the account is in standard state, you should try to do the restructuring. But even restructuring in case of NPAs is also permitted, but this restructuring is not for the purpose of evergreening. There should be a financial and business viability which should be there behind when you are trying to lend this particular additional money or giving some concessions to the borrower, right? So when you restructure a standard loan which is there, the borrower is in standard state, but you do a restructuring, it will be treated as substandard, and the IRAC norms for substandard will kick in, right? If an account is already an NPA, then depending on the stage where that account is, the provisioning will be done. It will still remain in that NPA category. Now, can the account be upgraded? yes, the account can be upgraded, but there are conditions which are there. So the condition is that when you have restructured it and you have agreed that you are going to get a certain repayment after a certain period of time, then once the 10% of such dues are cleared, then you are allowed to upgrade that account as standard, because you are now assuming that the borrower has gone into a normal business cycle and he will be able to repay the balance, right? However, that upgrade, even at 10% repayment when it happens, cannot be done immediately. It can be done only after 12 months, which are there, right? And if there is a long moratorium which is there, right, as part of the restructuring arrangement, you do a moratorium, then in that case you cannot immediately do the upgrade. After the finishing of the moratorium, you have to still wait for 12 months. You have to also look at whether the borrowers is having a facility repayment capability or not before you upgrade, right? So there are also restrictions for the large borrowers who are having facilities over 1,000 crores and you have restructured. Then there you can upgrade only after looking at their satisfactory performance, and there should be a credit rating done by a credit rating agency, and if the rating is BBB or above, then only you will be able to restructure, so upgrade the restructured advances which are there. And if the facilities are over 5,000 crores, then the rating is required from two rating agencies, and that should be above BBB, which is there, right? So restructuring is a sort of way to address the problem early or even after it becomes an NPA, but the provisioning norms continue and upgrade is possible only after certain conditions, right? The next option, and which is very prominently used by many of the banks because of the fact that this asset goes out of the bank's books once it is sold to the asset reconstruction companies, right? So ARCs, asset reconstruction companies, are registered under RBI and they are regulated under the Cersei Act, what we talked about. And these companies, what they typically do is that they take over the NPA assets which are there, and they will typically have to pay a minimum amount of 15% in cash, and 85% of the amount will be converted into a security receipt, and this will be appearing as an asset on your balance sheet, and against which you will have to keep on making a provision which is there, right? This is based on, again, like a non-SLR securities. Whatever provision norms are there, they are applicable to the security receipt which is there. So what happens is that the ARCs will try to recover their money from the borrower. They will file suit, they will go into discussions, settlement with the borrower, and they will try to recover. Once the money is recovered, the first money will go to the ARC, and then the remaining money will be used to liquidate the security receipts which are there. So as the recovery happens, the security receipt value will go down. But having said that, you will have to continue to make the provisions as if you are making a provision for non-SLR securities which are in the NPI status, non-performing status which are there, right? Next possible option to recover is IBC. We will talk about it under the legal framework which is there. And the last option is called the one-time settlement, right? Here again, there should be a policy for one-time settlement which should be there. And there should be proper authority which is there. So typically what will happen is that the borrower may come back with a proposal saying that instead of 10 crore which is due to me, I'll pay 7 crores and let us close the deal. Let's close the relationship. And the bank may decide that, okay, 7 crores, it's much better to recover the money rather than waiting endlessly to go into the litigation and get the money. Typically, they can get the money, and whatever is not received will have to be written off, right? So typically, one-time settlement, again, it will have to be done with a proper approval, board approval policy is also required. Similar case is required in case of restructuring and sale to ARCs. Again, board approved policy is required and proper approvals are required before you can undertake such activity. The last recovery option which is available is called the legal option. And let's look at what are the legal remedies which are available to the lenders. Okay. In terms of legal remedies, what has typically happened is that the banks have been able to recover around 14% in FY21. So not a very large amount has been recovered through the legal means. The legal means typically take a lot of time. The IBC was expected to fast track that process, but even then, it is still taking a slightly longer time. Typically, what is happening is that the recovery percentage is, if the security is good, the banks are able to recover around 70% of the amount. And it typically takes between 3 to 4 years before the money is received. So that is what the current situation is in terms of the ground reality. So in terms of first option is the for lok adalats, as it is called, and this is for the loans up to 10 lakhs, and that is for individual small loans like personal loans, housing loans, credit cards, etc. This mechanism will be typically used, and the lok adalats will be typically organized by the state authority or the district authority or the Supreme Court Legal Services Committee or the High Court which is there. The parties can go to lok adalat to settle the dispute. It is more of a compromise or a settlement kind of mechanism rather than the actual litigation type of thing. So you will try to reach a compromise in that lok adalat, and that award is binding on the both the parties. And once if the settlement cannot be reached, then the case will go back to the court, which referred the matter to the lok adalat. And in many cases, the lok adalat itself may ask the parties to seek the legal advice rather than settle it in the lok adalat forum, which is there. Right. The second option available is called the civil suit. So civil suit is when the borrower refuses to pay and the lender is trying to recover the money under the civil procedures code which is there. So a suit will be filed in the appropriate court, typically the district court or the high court, where the claim will be filed. And the only catch over here is that the claim has to be filed within 3 years of the date of cause of action. So when the account becomes an NPA, you will have to file the claim within 3 years. That is what is required. Civil suit, again, is a long process. It has got multiple stages: pre-filling, filling, post-filling. Then there is a decree, then execution of a decree, and there could be appeals which could be happening as a result of it. So it's a long-term process, but it is treated in a civil court which is there. The next one is called the criminal suit, which is there. So Supreme Court has clearly said that failure to repay doesn't directly mean that there is a criminal offense which is there, unless you can prove that there is a fraudulent intent which is there. Right. So criminal prosecution can be, a criminal suit can be filed when you can prove that there is a cheating or a dishonest behavior or a fraudulent behavior which was there. And that is when you can actually go and file a criminal suit. This is one of the ways to put pressure on the borrower, but there are caveats to it that you cannot just file it randomly against the borrower. There should be condition precedent to reach to that stage. Another case where criminal suit can be filed in case of check bouncing, Section 138 of the Negotiable Act, which is there. So the payee can file criminal proceedings against it, and the punishment for the check bounce is not more than 2 years or a fine that could be more up to 2 times the check amount which is there. That is what you can do as far as the criminal suit is concerned. So typically, in case of forensic audit, where it proves a fund diversion or a fraud kind of situation, that's where criminal suit is also filed in addition to the civil suit which is there. Right. The next one is called the RDDB Act, Recovery of Debts Due to Banks, RDDB 1993 Act, right? So this particular act was enacted based on the Narsihan Committee recommendation. And this goes back almost 30 years back. In 1991, there was a recommendation that there should be a sort of body which will decide and fast track recovery mechanism for the banks, right? So that is why this RDDB Act was established. And there are two sort of streams which have been established under that. So one is called the Debt Recovery Tribunal, DRT as it is called, and the other one is the Appellate Debt Recovery Tribunal, which is there, DRAT, Debt Recovery Appellate Tribunal, which is there. So which is nothing but an appellate authority which is there, right? So whenever the bank has got a recovery of debts which is there, it can approach the DRT where the borrower is located, and then the DRT will issue a summons to the borrower and understand the borrower's positions which is there, and then DRT will decide on that particular case. And the party, if the borrower feels that he is not getting a fair deal in the DRT, they can appeal before the additional DRT within 45 days of the DRT order. The bank can also file, or the borrower can also file. The aggrieved party can file the appeal with the additional appellate debt recovery tribunal, and that has to be done within 45 days. And typically, when the borrower files a complaint, the borrower has to deposit 50% of the outstanding dues to the bank when he is filing for a appeal in the DRAT court, which is there. But DRAT is also authorized to reduce or waive the deposit requirement, which is there. So this is again a mechanism to recover your dues through the debt recovery tribunal route, which is there, right? The next one again is a very important act which is there, Cersei Act. There is a long narration which is there, but the short form for that is the Cersei Act 2002, and this is again coming from the Narsihan Committee recommendations which are there, and which said that the banks or the FIs, they should be able to sell the security which is mortgaged or pledged or hypothecated to them without getting involved in the court proceedings which are there, right? So that's why the Cersei Act 2002 was enacted, and about 27,000 crores have been recovered in FY21 under this particular proceedings, and it's about 41% recovery rate which is there in this case. In case of RDDB, the rate is abnormally very low, only 3.6% which is there, whereas Cersei has shown a better promise which is there, right? So under Cersei, there are 42 sections and 6 chapters, but chapter 3 which is there between section 13 to section 19, they are the most important of the lot. And under this Cersei Act, 3 possible modes of recovery are available to the lender. First is called the securitization. So if the asset is in the performing state, then the same can be packaged as form of securities and sold it as a securitized assets. The second option is the sell to ARCs, that is available only in case of NPAs, what we talked about before. And the third is the enforcement of security interest. So you take the possession and you can sell the security without the intervention of the court which is there, right? In case the borrower tries to take these 3 modes of recovery which is there, the borrower can appeal to DRT within 45 days, and the DRT will give a decision based on the appeal which is filed by the borrower. If the borrower is not happy with the DRT decision, he can go into appeal with the appellate tribunal within the 30 days of the DRT order. Again, 50% of the amount has to be deposited when you make an appeal to appellate debt recovery tribunal. But again, the tribunal may reduce the amount to 25%. So this is one means of recovery which is available to the lenders. The next one is called the Insolvency and Bankruptcy Code 2016, not a very long past. This act has been enacted. This is enacted very, very recently. So it is still in the nascent stage, but it has changed the relationship between the debtor and the creditor. So previously, the lenders used to be at the mercy of the borrower, and if the borrower does not cooperate, then the lenders didn't have too much of leeway to really force the recovery. Whereas in the case of IBC, there is a sort of control given to the lenders also, and they can force the recovery option in such cases. Right. So in terms of statistics, up to September 30, 2022, right from inception, 7.96 lakh crores claims were made to NCLT, and about 2.43 lakhs have been recovered. So the recovery rate is about 30%. That means that the lenders have to take a haircut of 70%. But when you look at this 30% recovery, you have to also understand that there are few big ticket settlements which happened under the IBC, like one large steel case which happened, which was a substantial amount, and that improved the recovery percentage. In all other cases, the recovery percentage is not that high, which is there. In terms of the recovery itself in FY21, of course, is a flowing traffic. So what happens in FY21 actually could have originated much earlier. In FY21, the 27,000 crores were recovered, and the recovery rate was around 20%, right? So under the IBC, this is a topic of discussion on its own. Could take 2 hours just to discuss on this particular topic. But just in a nutshell, this Insolvency and Bankruptcy Board of India, that is the regulator for overseeing IBC proceedings. And IBC operates through 2 legal forums, just like DRT. It has got National Company Law Tribunal, NCLT, and NCLAT, which is the appellate tribunal, which is there, right? And in terms of the recovery, the code envisages the recovery through a corporate insolvency process or a fast track process. And if that does not work out, the second option available only is the in the liquidation of the company. In case of corporate insolvency process, the financial creditors have to apply to NCLT, and within 14 days, the NCLT will apply interim resolution professional. The interim resolution professionals will form the committee of creditors, and the committee of creditors will appoint a resolution professional. So all the people who have got claims against the company, they will be part of that committee of creditors. And the resolution professional who has been appointed, he will prepare a resolution plan within 180 days, and that has to be approved by the committee of creditors. And that has to be approved by NCLT, National Company Law Tribunal, which is there. 66% of the maximum value, majority value has to approve the resolution plan. Then only it can go to NCLT, which is there. If the COC decides not to approve, then the liquidation is the only option which is available under CIRP. And the secured creditors who have got the security, they have got 2 options if the company goes into liquidation. And one is that they may choose to remain out of the CIRP process, and they will recover their dues from the security what they have got. That is one option which is there. Or second option is that they will give up the all the rights which are there to the security, and they will participate in the liquidation proceeding. So they will be at par with the other secured creditors ahead of all, but except with the workman which is there. Right. Fast track insolvency is again for small companies which are there, and that process has to be completed within 90 days. I forgot to mention the resolution plan in the earlier case, corporate insolvency CIRP, there could be an extension by 90 days beyond the 180 days to get the resolution plan in place, right? In case of fast track, the whole process is expected to complete within the 90 days, which is there. And the insolvency and bankruptcy code also puts a pecking order in which everyone will get the money when the resolution happens or the liquidation happens. So that is what is one very, very important sort of legal means which are available with the lenders to recover their money. Any other question? Any other question on recovery or on the legal process?
Sir, we have some queries. If you want to take it. So,
we can take it later. I'll just finish these 2 slides and then we can take the query.
Yes, sir.
Yeah.
Sure,
okay.
sir.
Yeah, okay. So one other thing which is very important in this recovery game is the misconduct risk. And recovery, as typically I jokingly say that it is like a physiotherapy. Now, if you have got a frozen shoulder, for example, what the physiotherapist typically does is that he applies certain pressure. He makes you exercise in such a way so that your shoulder gets free. But if he applies wrong pressure or he applies too much of pressure, your situation may get worsened, right? So here there has to be a perfect balance when you are trying to recover the money. How much pressure you are going to apply without really sort of having a high-handed attitude or insulting the customers or treating the customers very badly. How you can recover the money is a very important aspect, and that is why misconduct risk comes into picture. So there are various guidelines which are issued by RBI regarding the customer service. First one is the bank's commitment to customers. Secondly, there is a circular on loans and advances which lists out how the loans and advances are to be given. There is a circular on customer service which is there, which requires that there should be a committee in the board to look at the customer service. There should be a mechanism to handle the customer service. What are the service standards which will be followed? What will be the grievance and redressal mechanism which will be there? And what will be the compensation which will be paid? All these factors will be coming in this particular area. Fair practice code for lenders is again treat your customers fairly guideline where when you are lending, you should transparently disclose your terms and conditions, your charges, your interest rates, what will be the benchmark which will be used, what will be the penal interest, how the interest will be computed, when will interest be fall due. All those things you will have to explicitly set out. So if you are a retail customer and you are taking housing loan, you will typically see a separate document which you have to sign, which is called MITC, most important terms and conditions. This is nothing but coming out of this fair practice code which is there, right? The other 2 boxes on the right-hand side, they are internal ombudsman and banking ombudsman. These are the 2 institutions which have been set up to handle the customer grievances which cannot be satisfactorily handled by the bank, right? So internal ombudsman is appointed by the bank, and that particular ombudsman will look into the cases where the customer complaint has been rejected by the bank, and he will look into the reason whether that complaint has been rejected on a fair grounds or not. And that is the purpose why internal ombudsman has been put in place, structure has been put in place. That person is not part of the bank. It's a officer with a substantial experience appointed from externally from the external to the bank to look into such aspects. Banking ombudsman, on the other hand, is appointed by the Reserve Bank of India, and they will look into the cases where the customer complaints have not been satisfactorily resolved, either through the normal route or through the internal ombudsman. In many cases, the customers can directly approach the banking ombudsman also, and the RBI ombudsman will look into the case and give its verdict. if a compensation is to be paid for deficient service or not, right? When we were talking, we also talked about one important thing on the recovery aspect is the recovery agents. And I gave you the example that in many cases, the banks handled the customers with a high-handed way. They threatened the customers, intimidated the family members. They insulted the customers in public. They also created a ruckus in the family functions of the borrowers. That kind of a thing happened. So that is why there is a circular on recovery agent. So there has to be a recovery policy which has to be put in place. And the recovery agent appointment has to be done after a proper due diligence and verification which is there. There has to be a training given to the agents to handle this particular activities. They have to be polite but forceful at the same time. They don't have to insult the customer. They have to be courteous to the customer, but they have to recover the money also, right? So that is what they have to get that fine balance. So training is required to get that fine balance, right? Next thing is that the borrowers also have to be intimated that they have appointed a recovery agency, and that is what they will have to be informed. The recovery process is that the recovery agents cannot contact the customer outside of 7 to 7, like 7 a.m. to 7 p.m. They can contact the customer. They can meet the customer at the customer's usual business place. Normally, they are not expected to meet the customer at the customer's house or his personal place unless the customer requests for such a meeting which is there. They are not supposed to invade in the personal functions and all that, like, say, bereavement or a funeral or a family function which is there. So they have to provide the customer with the proper account statement, what is the amount due, how the amount is computed, all those kind of things. Right? The next thing is the recovery agent incentives. So they have to be properly determined, and it should not result in encouraging agents to go into using unfair means to recover. That is what has to be ensured while granting the incentives to the recovery agent. The recovery agent's performance has to be periodically reviewed by some responsible officer. And there has to be a complaint handling mechanism. If there are any complaints against the recovery agents, they should be handled as part of the customer complaint thing. So there should be a mechanism which should be put in place as part of the recovery recovery agent process which is there. So that gives in nutshell, the overall view about the recovery agency. I've already talked about the technology, because technology is a great enabler. You will get the information from various sources. You will use many of the things are now automated in the bank, and loan origination or credit rating, loan management system are more or less automated now. And core banking is there in almost all the banks now. So, and that will be used for finally the reporting which is there. That's the enabling technology is there. I missed out one box in this slide, which is the early warning signal. That I have missed out. But that is, again, there is a system which is put in place by the banks to identify such cases, right? So that brings me to the end of the presentation as such. If time permits, I wanted to actually cover how the actual early identification process happens in case of corporate and retail customers. But I think we are running behind the schedule. If 15 minutes time is there, I can cover that. But we can take the questions first.
Yes, sir.
Yes.
Sir, first query is, what are the expected effective steps that the agencies are taking to recover the substantial NPA that you have mentioned in your presentation?
So if you go back to the slide which I showed you, we have looked at what are the recovery mechanisms which are available with the various ways in this recovery can be happening. The upgrade can happen, the cash recovery can happen. You can try to get the security or the collateral, invoke the personal guarantee. You can restructure, you can sell to ARC. There are various ways to recover the money. typically in case of retail, and that is what I actually wanted to cover. If 10-15 minutes time is available for us to go over time, I can take that and explain to you. What typically also looked at is not only the cash flows which are available with the borrower, but also any kind of security which is available with the customer, like any other financial assets, shares, any property which is there, mutual fund units which are there, which can be liquidated to recover the money. And the recovery agents will typically persuade the customer to liquidate those to repay the bank's dues. So apart from whatever I have mentioned, these are typically specifically happening in case of retail customers. I would like to highlight. I hope I have addressed.
Yes, sir. So the next one is, are there any mechanism virtually online basis with banks to at least examine, if not correct or control such NPAs? If so, what are the measures?
Yeah, so if you go back, can I just share the screen again, which can, I think, maybe refresh the memory. So if I go up. So if you look at it, what we talked about, the preventive and detective controls which are there, I explained to you, there are various information sources which are available, and all these things are done online now. You can go into GST portal and you can see how much a borrower has reported as a sales turnover, how much GST he has paid, right? You can go to CRILIC, you can go to Cersei, you can go to PAN, Aadhaar, you can check how much is the income which is declared by the borrower, right? You can look at the tax returns which are there. All those things are now available online, which is what the banks can utilize to weed out this fraudulent type of borrowers. One other thing which is also there, which I mentioned, is the negative news information service which is available. And this is available across even after the assessment is done. I forgot to mention, typically these are used for credit monitoring. The negative news and all those things are used for credit monitoring, but they can also be an input when you are actually granting the credit, right? The bank analyzer, which I talked about, which can help you analyze the entire bank statement and tell you where the money has gone, right? So all those things are also available. There are lots of innovations which are happening where fintechs are playing a big role. So these things are obviously in a flux right now. Things are likely to change even further. Lot of things you can check the credit rating, credit scores now are available online. You can find out how much the borrower has borrowed. All those things are now available online. So many cases, if you are applying for a retail loan nowadays, you will find that within 60 seconds you will get an approval. That is possible only because of using all these information sources, internal, external, and publicly available and paid resources which are there.
Right, sir. So the next question is, are measures like Lok Adalat, DRT, still relevant now that we have NARCL and IDRCL?
Yeah, so NARCL and IDRCL, they are recently formed, not too long ago, I would say. And the only advantage vis-a-vis the asset, they are nothing but asset reconstruction companies. They will take over the assets, pay some portion in cash, and try to recover the rest of the money. The only advantage in case of NARCL and IDRCL is that these are guaranteed by the government. So that way, there is a good amount of recovery chances. But one thing you also have to admit, that only the large borrowers will come into picture in this particular case. They will not take up all small and sundry borrowers. They will not be taking on board. If you look at the figures which are being quoted, like they are likely to take over, they are running into thousands of crores, hundreds of crores, if I'm not wrong, right? So they will be good for large borrowers, but for small and medium type of borrowers, still these other mechanisms will play a role. Your voice is on mute.
So the housing loan, education loan, vehicle loan are sanctioned by the Retail Asset Hub. but loans are appearing in the balance sheet of branch under audit. Branch replies that documents are at RH. So please advise how we can check irregularity in the documentation in such loans routed through RH.
Okay, so this is a problem which is being faced. So nowadays, I forgot to mention on technology slide one other important element. While I was talking, I just realized workflow is another very important element in the technology, enabling technology. So what is nowadays happening is that the whole underwriting process is happening through in an automated fashion. All the information is coming, documentation is also online. Typically, that is where the banks are actually moving into. The progressive ones have already moved into that cycle. The rest are all already in the pipeline. If you look at the RFPs, which are issued by even some of the public sector banks, they have issued RFPs for LOS and LMS very, very recently. This is trying to automate that whole process so that you will be able to look at the documentation. It will be scanned and kept at one location. Physical copies will be kept in one location, but can be accessed from anywhere. So that will address the problem. There is no immediate solution, I would say. It will still take some time till the time this whole process gets completely automated. Till that time, you will have to ask for that information. Typically, in audit, we do that backward and forward. Unfortunately, that pain will not go away.
Right, sir. So the next one is, if a borrower availing CC limit from one bank and maintains a current account with other bank where sale proceeds are credited and interest in CC account is remitted from current account, whether auditor can classify CC account as NPA due to insufficient credits?
So this was the problem which was happening. And I don't hesitate to mention it. Many of the borrowers had opened the account in cooperative societies because cooperative societies did not have a good core banking solutions. So that is where they would use that sort of lacuna, technology lacuna, I would say. So the RBI has now stopped that current account being maintained with other bank where you don't have credit facilities. The current account now has to be maintained with the bank where the credit facility is given. And answering your question, if the credits in the account are not sufficient, right, technically that account will become an NPA.
Yes, sir. Sir, if government grant received in any government-sponsored loan scheme, but no payment done by borrower, in that case, what will be the account status? It will be NPA or not?
I don't. I'm not able to visualize which kind of facilities we are talking about here. There are facilities like, say, for example, PM. That housing scheme is there, PMJAY, if I'm not wrong, right? So there is a subsidy which is given, or in some cases, the part of the loan is sanctioned by the borrower.
Yes, sir.
But the part of the loan is still has to be taken by the borrower. The government doesn't fund 100%. I have not at least seen such schemes. Maybe there could be some schemes where 100% grant is available. I'm not aware of it. I'm sorry on that.
So the next one is, please clarify if all accounts of a company, including cash credit account, are regular, but account of its parent company is irregular. Will the account of subsidiary company shall be classified as NPA?
My offhand answer is no, although I would like to check with my expert team. I can come back to you on this, but each borrower is treated differently. That is what my understanding is. So the parent company, if it's an NPA, it will be an NPA. As long as all the facilities of the subsidiary are in order, it will not be considered as an NPA. But from the recovery, NPA and recovery management perspective, that's an early warning for you, because what it means is that in case this particular subsidiary company goes into a problem, there will not be any support available from the parent company now, right? So you will have to assess your situation very, very carefully. It's a first sort of red signal for you that this account could go into a problem.
Yes, sir. So that's all. You have taken all the queries, sir. I would like to say thank you. Thank you so much for taking the session. It was an excellent session, sir. Thank you for enhancing our knowledge and giving the practical aspects on a very important topic. A formal vote of thanks from the Committee on Management Accounting. Thank you so much, sir.
Thank you. I just wanted to check if the participants are okay to get 10 minutes of the time, because there is something which is very interesting, which I just wanted to highlight, but I ran out of time.
Yes, sir. Yes, sir. Yes, sir. We can continue for the 10 minutes, sir.
Yeah. So what I wanted to highlight, I'll just cover the critical slides which are there. So in case of retail accounts, typically what happens is that you have got large number of borrowers which are there. Some are secured facilities, some are unsecured facilities which are there. So for example, there are 10 lakh accounts in a bank which are there, right? And you can't go after all 10 lakh accounts to recover your dues whenever, say, on a monthly basis, there is an installment which is falling due. You can't go after all 10 lakh accounts and try to recover the money. It will require a large army, equivalent to Indian Army, to recover the money, right? So the typical way to handle this is to do an early warning signal analysis. And typically that is done by using some mechanisms. Like, say, for example, you can get the information from credit bureau about the change in the customer's profile. Has he borrowed money from the other lenders or not? Is there any change in customer profile? This will be based on interaction with the customer. For example, he has got married, there is a child in the family, right? Or he has lost his job, right? All those things will mean that he will not have a disposable cash available to repay your installment which is there. Credit bureau, I already talked about. News items and external events are like this. For example, the person is working in company A and that company A has gone into lockdown. Obviously, the money is not going to come back because he will not get his salary, which is there, right? Or in some cases, for example, the person is working in an auto industry and you read the news item that there is a huge stock of cars which are lying in the warehouse remaining unsold, right? So if such a situation is there, the next step the company is going to take is that they are going to cut down on the production, they are cut down on the salaries, they may have a retrenchment plan also. So all these things will tell you that something will be happening to that borrower and you will not be able to recover the amount which is there, right? So once you do this, that is what is called the statistical or sort of modeling which is used based on parameters to identify who are the borrowers who are likely to default, and default probability modeling is typically done. So credit bureau, news items or external events, they are the inputs anyway, changes in the customer profile, and also what is the customer's past track record, has he been honoring his commitments or not. Based on that, you can decide as to out of this 10 lakh customers who are likely to default, maybe say 1%, out of this 10 lakh customer, 1% is likely to default, right? Because of these conditions which are there, which requires special attention. The rest of the 9,99,000 customers will pay the amount in a very systematic way, right? So these are the customers you would like first identify, which you will focus on, right? The next thing what you will try to do is that find out amongst these customers, say our sample is say 10,000 customers which are there, right? Then what you do is that you try to identify out of these 10,000 customers, it is still a large number to go after. You will try to identify which are the customers where am I likely to recover vis-a-vis the 1 unit of effort or time or money which I spent. Where am I likely to get the money, right? Recover my money, right? That is where you would like to focus, right? The chart which I showed you before, recovery and results and return, right? Effort versus return, right? So here what you will look at again at the past track record, you will look at other financial assets. Does the customer have got any asset which are there, mutual fund units, investment in shares? Has he got FDs? Has he got any other investments which are there? because those could be utilized in case the customer runs into a problem, right? So these are the customers where if the customer runs into problem, then you may force the or rather push the customer, not force, push the customers to liquidate some of these assets and settle the bank's due, right? The other thing which is very important is what is the security or the collateral which is available with you. If it's a shares, for example, pledged shares or a deposit under lien, then you are practically covered because you will be able to recover some money out of it. If it's a security which is to be enforced, then do you have the agreements? Do you have the wherewithal to recover, enforce the security? For example, enforcing a security in case of housing loan, that might be a challenge, but still it could be feasible to recover the such money, right? So you will look at that. And finally, you will look at what is the customer's reputation, integrity, what is his propensity, basically. Does he, a sort of trustworthy, honest person, he will go all the way out to settle the dues of the bank because he values his reputation too much than anything else, then such customers are likely to repay you rather than default on it, right? The fraudsters like non-cooperative and willful defaulters, they will default, but such customers who value their reputation, they are the ones who will repay, and those are the customers from whom you will be able to recover the money. So if you start with 10,000 accounts, you can, based on default probability which you get, on this recovery probability, you may end up in having, say, 1,000 accounts, where you will get the maximum result by using this particular mechanism. The other important thing is also using the communication strategy to reach out to the customers to get the money, right? So it depends on the customer profile. So typically, you must have been seeing that you get the SMSs, emails, just before the amount is falling due, right? So that kind of a thing, if the customer is educated, that may be a useful way of communicating, right? SMSs could be another way of doing it. Automated dialer is also used in case of calling of the customers. That is again a sort of mechanism is there. Personal visit is, or having a call through a recovery agent is a costliest affair. So email is the least costly, whereas the personal visit will be the highest costly kind of affair. So you, based on the customer profile, you will have to choose. Say, for example, if it's an old customer, he would not use the SMS or email kind of thing. Typically, he will require a letter to be sent, right? Or he will require a call to be made. Then only he will pay, right? The other important thing, and there is a science and study which has been done as to what is the past track record of the customer? When does he respond? If you call up, what is the time when does he respond? Right. So typically, what the studies show that the time when people are traveling to office or some free time after they have checked out their emails. So the time before 9 o'clock, for example, or time between 10 to 11, and then in the evening between 4 to 5 when people are winding up, or between 5 to 6 when people are traveling back home, right? Those are the times people are likely to pick up the calls, right? They are likely to respond to calls. That kind of analysis you will have to do, figure out at what time the customer picks up the call, at what time which channels the customer responds to, right? And this kind of analysis you can do based on the portfolio itself. Say 10,000 customers, what is the mechanism? Say in 3,000 customers, SMS works. 2,000 customers, you need to have personal call. 1,000 customers may require personal visit. That kind of analysis you can do. So you can choose a channel, you can choose a mechanism, you can choose a timing. Again, there is a models which are being used to identify what is the best way to approach the customer. And finally, time, cost, and effort is critical. So here, if you send an email, that's zero cost. Send an SMS, it will be slightly costly. You use an auto dialer, it will be still more costly. You ask the recovery agent to make a call, it will be still more costly. You ask the customer to make a personal visit, the recovery agent to make a personal visit, it will be the costliest. So you have to decide where you will use what kind of tool which is there. So it is like when you are in a war, You decide what you want to use. Are you going to use a pistol? Are you going to use AK-47? Are you going to use a light machine gun? That kind of a thing you have to decide when you are battling this retail credit. But retail credit is a typical challenge because large numbers spread across the country, different types of profiles, some educated, some part educated, elderly people, housewife. The products itself are like secured, unsecured, all kinds of flavors are there. So retail credit is typically a challenging game. And that's where all this technology and the models which are being used. The next one is the MSME and corporate credit. Again, we talked about early warning signals. So that could be your information source. Identify the information early so that you take action early, right? There are borrower or industry analysis report. In case of large borrowers, that could be one other information source which is available. You can look at KRELIC or commercial bureau data which is there. Whether the customer has taken any additional loan from anyone, what is his score, is his score dropping, all that kind of stuff you will be able to check out. Cersei and ROC data, you can check out what is the seniority of your claim vis-a-vis the other borrowers, because Cersei will tell you the seniority of the claims which are there. News items and market information, as I said, there are service providers which are there. And of course, you have to keep on monitoring the external events. So typically the financial institutions, large ones especially, they have formed a market intelligence unit to look at the external events and identify which part of the portfolio will get impacted, right? So that is how they are trying to sort of gear up before the actual accounts becomes an NPA. So in nutshell, if I have to summarize, if you have to tackle the NPA problem, first, don't allow the bad borrowers to get into your books, number one. Number two, if there are some people who are likely to default, they will get into overdue, they will likely to default. In that case, you have to take early measure to bring them back from SMA into standard category. If they become NPA, you start taking early action for recovery. And credit monitoring, these information sources which are not now available, which were not available before. About 20 years back, this kind of sources or information was not readily available. Now it is available. So it is for the banks to use it. And that's only can bring down that GNPA and NNPA level, what we talked about. If we are able to bring it in line with the developing world, developed economies, I think 5 trillion is a pretty much achievable target. That's what I would like to say as my last word. Thank you very much.
Thank you. Thank you so much, sir, adding all these slides. Thank you for sharing your vast experience with our members. A big thank you, sir. Thank you so much, sir.
Thank you very much. Thank you for your time, and look forward to another session some other time. Thank you.
Yes, sir. Thank you, sir. Thank you so much.
Thank you. Bye.